So what I think is really interesting about the market is you have stocks inching near all-time highs, you have bonds that are moving up, and real estate moving up. So these are all very good things. So why are there so many questions? Well, is there stability in some of these gains? We have stimulus in the economy. We're hearing questions like, is the market overheated? Are we overdue for a correction? So these questions are warranted, and we're going to address a lot of them here today. Before we do that, I want to look at some of the reports that hit the market this week. Now, we look at this every week. Sometimes we're light on reports. Sometimes they're a little more intense. If you can't tell from this list here, it was a big week as far as reports go. Everything from measures of inflation to housing starts. The Fed released their minutes this week. New home sales, Case-Shiller. I mean, a whole bunch of stuff came out this week. Here to comment on all that, our financial analyst with the Reyes report, David Reyes. So, David, we've talked about stocks and bonds working in a seesaw. That CNBC video just talked about a tug of war. I've heard you in the past say good news is bad and bad news is good with the stimulus. So if we haven't confused our audience enough yet, I'd love for you to step in and maybe help us understand it a bit better.
Well, I'm confused, but that's okay. Hopefully, can make you a little less confused. The biggest thing that happened this week was the Federal Reserve minutes, the FOMC minutes, which are closely watched and can be market moving. The biggest comment that was made, and these are kind of gone over with a fine-tooth comb, was that one of the Federal Reserve chairmen wanted to increase rates immediately. That caused a little bit of disruption in the market, but the market continued to kind of shrug it off. And, what concerns me a little bit about that is that Janet Yellen, our federal chairwoman, was talking about rates rising in June of next year, and they really have kind of laid the groundwork to increase rates sooner. As you know, they're going to be stopping, if you don't recall, tapering in October. So, that is a cause for concern if you're looking to buy a house or things like that. Probably now's the time. The stock market continues to climb this wall of worry, but we're back to all-time highs again. My biggest concern, quite honestly, is the bond market, both corporate bonds and treasury bonds. And if we do see the economy continue to grow, the bogey for the Federal Reserve is 6% unemployment, which are currently about 6.2, and 2% inflation. We're at about 1.9. So we're really right there where we're really kind of calling out where the economy is stable. Most of us have not been through a bond bear market. Most of us have been through bond or stock bear markets. To give you an example, from 1950 to 1980, which would be the most similar time that we have to today relative to interest rates, real bond rates of return were down 40% from 1950 to 1980. So there's an old saying that Mark Twain said I like. He says, history doesn't repeat, it rhymes. So you need to pay attention to that. And so that on a forward basis would be my biggest concern for the marketplace, actually.
Well, I can appreciate that in past shows you've never tried to predict where the market is going, rather making sure you just have a good plan in place. You keep an eye out for maybe some of these ticking time bombs, looking for things. You've mentioned inflation, your investments, how they're going to be taxed. Are you well diversified? These are things that no matter what the market does, you can look out for. And I hope our audience will reach out to you and get a second review. I know that you offer this. If you visit reyesplan.com, R-E-Y-E-S, reyesplan.com, David is happy to do a free financial review for you. He's a wealth of information, no pun intended. I encourage you to connect with him. David, thanks for the great information today and helping us understand this a little bit better.